Hello, good evening. Welcome to our webinar. I'm going to give a couple minutes for people to come in and get settled before we start.
Buenas noches y bienvenidos a todos. Vamos a empezar unos momenticos antes de empezar. Gracias por su paciencia.
Okay, we have a lot to cover, so I will go ahead and get started. And if people trickle in, that is fine. But I want to let you know that this webinar tonight is being presented simultaneously in English and Spanish. Emily is our interpreter, and she's going to let us know now how the interpretation channel will work.
Thank you very much. Good evening, everyone. My name is Emily, and I am the Spanish interpreter tonight. Buenas noches y bienvenidos a todos. Mi nombre es Emily y voy a proporcionar servicios de interpretación en español esta noche. En un momentico vamos a encender la función de interpretación y cuando lo hacemos verá al fondo de su ventana de Zoom un icono de un globo. Presionando sobre el icono le va a dar la opción de seleccionar inglés o español para escuchar la presentación. Si se está conectando con móvil, necesita empujar los tres puntitos, de ahí escoger interpretación, pues español, pues listo. Si tiene cualquier dificultad técnica, por favor comunícase con nosotros en el chat. Disfruta la presentación. Thank you.
Okay, I will start the interpretation channel now.
Okay.
Okay, good evening and welcome to our webinar. Welcome to the official start. Tonight we're talking about maximizing tax savings, proactive planning for year's end. And what that means is tonight we're going to be talking taxes. Specifically, we will be going over the steps you can take now to both calculate your taxes for 2023 using a limited amount of information. So that means making the process a little bit easier for you. And we're also going to review the options you have to reduce your tax bill before the end of the year. And just a note, the information that is contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Oh, my apologies, I switched that slide a little too soon. And I'm having a brief technical difficulty, so I'm just going to stop this for a second and I will be right back to sharing my screen. I apologize. If you just saw, I have a cat who jumped on my screen, my keyboard, who moved things around. So now we are going back. Okay, perfect. And now I can advance the slide. Okay, so in today's conversation, we will discuss how you will get started in this process. That includes what information you need to gather what information you need to both gather and review in order to understand what your tax bill is likely to be. And then we'll go over some strategies for mitigating your taxes. That's the important part, right? Okay, so we call this a mid-year review, and you may be thinking that it's not exactly mid-year, right? It's October at this point, and it's, I hate to say it, but it's past the midpoint of October. But many business owners do a tax check-in, usually sometime between August and October. And so despite the fact that this is actually late summer into fall, you will often find this referred to as a mid-year tax review. This effort is an important one because it allows you to see your tax liability at a time when you can still do something about it. So as you know, at the end of the year, the opportunities you have to affect your tax liability, which really means to lower your tax bill, those opportunities end at the end of the year. Additionally, conducting a review can help you to understand your tax liability. So by law, you are required to pay at least 90% of your actual taxes for the current year or 100% of last year's taxes in order to avoid a penalty. So undertaking a tax review now before the end of the year can help you plan how much more you need to pay in estimated taxes in order to avoid paying even more in penalties. The review will involve checking your revenue, which is the money that you've taken in so far this year, and your expenses, which is the money that you've spent, and looking at that against last year's revenue and expenses, as well as the resulting profit. And as you know, profit is your revenue minus your expenses. What you'll also want to look at is how much you have paid in taxes so far, likely in estimated taxes. The process can be really as in-depth as you would like it to be, from just seeing if you are making more money this year as compared to last year, to essentially almost preparing your taxes ahead of time to see where they stand. And now we're going to talk about getting started. So before you start your tax review, there are 2 activities you should undertake. First, the first thing you want to do is review your previous year's taxes. If you are a sole proprietor, the easiest way to do that is using a simple free online app. We have one here at Civitas Strategies that we have created, and I will share that in the chat with you so that you will have access to that. The app that we've created is available in both English and Spanish, and you can use it at any time throughout the year. It's a really good way to get ideas for deductions and other strategies that you can use this year and in the future to reduce your tax burden. And as I mentioned, when I say reduce your tax burden, what that really means is lowering how much money that you will end up owing to the IRS. The second thing you want to do, the second step that you're going to take, is to collect information on your revenue, your expenses, and the estimated tax payments that you've made so far this year. So specifically what you want: revenue. When we say revenue, that means all of your revenue to date from any source. It can be subsidy payments, family payments that have been made to you, income that you get from the Child and Adult Care Food Program, and more. This could be if you received any stabilization grants through the state of Georgia, that money would be considered revenue as well. And it's payment in any form. So cash, checks, cash apps, things like Venmo. And you want to include not only the revenue that you have collected to date, but you also want to include revenue that you think you will receive by the end of the year. And then when we talk about expenses, it's going to be the same thing. All of your expenses to date, anything that you've spent on your business, so your payroll, your rent, your mortgage interest, utilities, supplies, with a quick reminder for home-based childcare providers that you will want to use your time-space calculation to get your business percent of those expenses whenever applicable. And the same thing goes here for expenses. You want to think about all of your actual expenses so far, as well as your expenses that you estimate you will have before the end of the year. And then the third thing you want to think about is your estimated taxes. If you are a sole proprietor, which a lot of you likely are, chances are that you're paying estimated taxes quarterly. If you are an S corporation or an LLC that is taxed as an S corporation, your salary will be W-2 income, and that will have tax withholding already in it, which is great. So you don't need to think about that. But what you do need to think about is your profit, the amount that you pay yourself above your W-2 income. That does require estimated taxes because you are not being taxed on that just yet. We will share more later in this presentation. I'll talk a little bit more about how to determine if you are on track for that. But know that you can log into your account on the IRS website and see exactly how much you have paid in estimated taxes so far this year. Chances are you also have records of that for your business. And just note, if you have a bookkeeping system that you use, something like QuickBooks or FreshBooks, you likely can get a lot of this information right out of that system. You could probably run a profit and loss report or something similar to get this information. But if you don't use an accounting system or a bookkeeping system like that, that's okay too. You can review your bank accounts, your credit card bills, all of the ways that you spend money, and then you can look at the payment methods that you use to collect payments from families, as well as your other sources of income, and collect all of the information that you need that way. And as a reminder, what I mentioned before, all of these steps can be as in-depth as you want them to be. So you can do a thorough look at all of your expenses and all of your revenues so far, or you can estimate and see where it compares to last year to get an idea. You can use actual numbers where you have them and estimates where you don't, but just keep in mind that the more in-depth and accurate your information is, the more accurate your results will be. I'm just going to take a quick pause and see if anyone has any questions. And I see there are a couple things in the chat, so I'm going to look at those. But if you have any questions, okay. Yep. So Margaret was asking, we did get the room started, and I saw a couple people introduce themselves, which is great. So thank you. If you have any questions, I know we've gone over a lot of information so far. Feel free to jump in. I see someone raise their hand. You can feel free to put any questions in the Q&A if you would like. And someone asked a question in the chat about not seeing the chat, but I think that is the chat there. And I haven't put, if you're referring to the information I said I would put in there. So can an S corporation pay taxes? So can an S corporation pay taxes from a business bank account? Yes, you can. You can absolutely pay your tax bill as long as you are paying your business taxes. You cannot, if you do your, Pam, if you do your taxes so that your personal taxes and your business taxes are done on one tax return where you are like a Schedule C, you probably you cannot use your business account for that. You can reimburse the business portion of it. So yes, Pam, if you are doing your taxes on a Schedule C and it's an intermingling of your business and personal, yes, on your 1040 with the Schedule C, you should pay that with your personal account, and then the business portion of that can be you can reimburse yourself. And a couple people are asking about the chat. There's nothing in the chat yet. You're chatting to the hosts and panelists. If you have questions, it's probably easier to put them in the Q&A. That way they'll go to other people, and then everyone will be able to see them. And the information that I will share at the end. I haven't had a chance to share that yet, but I will put the link to that that app that can review. I can do that now if that will help people. I will put this in here to everyone. So this is a link to the tax review app in English. And this is a link to the tax review app in Spanish. I would suggest looking at that after the presentation. And if you have questions, I'm going to keep going. But if you have questions, feel free to put them in the Q&A box at the bottom, and then we can see them. Oh. Yes, Laura, that's because there's no questions. Laura asked a question about not seeing questions yet in the Q&A. That's because there aren't any in there. Seema has a question. Does it mean that if we compare to last year's tax and revenue, this year, if I already paid more in 3 installments, so can I not pay the 4th installment? So Seema, a couple of things about that. If you have more revenue this year, you will likely owe more taxes. So just as a reminder, you do need to pay either 90% of the tax owed for this year or 100% of the tax owed last year. In order to avoid the penalty. You will have to pay the full amount at some point, but you just won't be penalized on it when it comes on your tax return. Does that answer your question? So just to clarify, Seema's question, because it sounds like no one else can see the questions. So again, just going forward, if you want to put your questions in the Q&A, but Seema asked, does it mean that if we compare to last year's tax and revenue this year, if I already paid more in 3 installments, and those I assume you mean the 3 installments of the estimated taxes, would you not have to pay the 4th installment? So in order to avoid a penalty, you either have to pay 100% of last year's amount of taxes or 90% of this year's. So as long as those 3 installments, those 3 payments that you've made meet that criteria, then yes, you do not have to pay that 4th installment of estimated taxes. But just know that you will owe that tax if it's due at tax time. And there is a question in Spanish in the channel that I'm going to see if Emily can translate that for me, but I will get to that, Martha, because I cannot translate it on my own. Okay. Okay, perfect. Okay, so we are going to go on to the next slide. So we talked about the information that you are going to get ready. Once you have that information ready, there are 2 approaches that you can take to estimate your tax burden. One that is called profit, we call it the profit-driven approach, which is based on your profit. And another one that uses a calculator based on your overall family income and the characteristics of your family. We're going to run through both options now. So we're going to start here by talking about the profit-driven approach, the first one that I mentioned. So this is one approach to estimating your tax burden. And now when I say tax burden, that really means bill. It means how much money you are going to owe the IRS. So of the 2 options that I mentioned, doing your review just based on profit is the fastest, but it's also slightly less accurate than basing it on your family income. So this option will take you roughly 15 to 20 minutes, depending on your record keeping and all of that. But it's a pretty quick step, a pretty quick process. And the first step in the profit-driven approach is to determine your profit. So we're going to take all of that information that you gathered. You're going to subtract your total expenses from your total revenue. And remember that your revenue so far should include your actual revenue thus far in the year and the estimated amount of revenue that you think you will have through the end of the year. The same goes for your expenses. Your actual expenses so far and what you think your expenses will be through the end of the year. You subtract revenue minus expenses, and what you get is your profit. And you can see the example on the screen. The provider that we're talking about here had $105,000 in revenue and $67,000 in expenses. That puts her profit at $38,000. So now she knows that. That's a key number. So we're going to move on to step 2, which is to determine your estimated taxes. When sole proprietors have a profit, they are required to pay both a self-employment tax and income tax on that amount. The self-employment tax rate is standard across for everyone. It's 15.3%. Income tax rate is determined by the amount of taxable income that you have. And depending on how high or low that amount is, it can range anywhere from 10% to 37%. If you're the owner of an S corporation or an LLC that is taxed as an S corporation, your W-2 income is already considered an expense. So like I mentioned before, all you have to think about is your profit. So and your profit is taxed as regular income. It's not subject to that self-employment tax. So I mentioned that the tax rate can range anywhere from 10% to 37%. A good estimate to use is roughly 20%. That sort of falls in the middle, and it is likely it is a good estimate that most people can get an average out of. That in 20% works well in a state that does not have an income tax. Georgia does have an income tax, like the majority of states do. So you could use 25% to be safe. It is always, it's always safer to overestimate rather than underestimate. So if you wanted to give yourself more cushion, you could use 25%. But in this example, as you can see on the screen, we're going to use 20%. So we're back to our example provider. She had $38,000 in profit, and she wants to estimate her taxes based on a tax rate of 20%. So doing that, $38,000 times 0.20 for her 20% leaves her with a total estimated tax bill for the year of $7,600. Using this rate, that's what our provider can assume she will owe by the end of the year. So now what she needs to know is how much she has already paid. So let's say she checked with the IRS site when she collected her data and she saw that she had already paid $6,000 in estimated tax. This is just an example. Say she has paid throughout her 3 payments that she's made already, she's paid $6,000. So knowing that her total estimated tax bill will be roughly $7,600 for the year, but she's paid $6,000, she knows that between now and the end of the year, or before the next estimated tax, when the next estimated tax bill is due, she will owe about $1,600. In this case, this provider had a positive number for her profit, but let's just say for example's sake that she didn't, and she found that she would lose money by the end of the year, which, as we all know, that can absolutely happen. In that case, if her profit was negative, her estimated tax bill would be $0. She would also want to look closely at her revenue and expenses to see if there is any way to cut costs and boost revenue, because while a $0 tax bill is nice, she would also want to make money, right? And now we're going to talk about step 3, mitigating taxes. So before you write a check for that remaining amount, for in this provider's case, it would be that $1,600. You really want to look at the section, you really want to look at your options for mitigating your taxes. We're going to talk about that in just a few minutes, but you can use them to adjust your numbers to better know what you should pay before the end of the year. So talking about our example provider, let's say she decided to take $5,000 from her profits and put that money into a SEP IRA. A SEP IRA is a kind of business retirement account where the costs are completely deductible. So the amount you put in is fully deductible from your business expenses. So thinking about that, her revenue would still be estimated, excuse me, at $105,000, but her expenses would go up from to $72,000. That's her original $67,000 in expenses plus that $5,000. So now she has $72,000 in expenses. That brings her profit down to $33,000. Since her profit is less, her estimated taxes will be less too. And I'm going to confess that I did this math ahead of time. I'm not doing it this quickly, but if she had a $33,000 profit and multiplied that times an estimated tax rate of 20%, her overall estimated tax bill would be down to $6,600. And since she has already paid $6,000 in estimated taxes in this scenario, she would only need to pay $600 more by the end of the year. So that's just one example of a way that you can take a step now to mitigate your taxes, because you would have to open that IRA and fund that money before the end of the year. And I'm just going to take another quick pause because I know I threw a lot of information at you, and look at a couple of the questions in here. Is this class for administrators and owners too? Absolutely. This, and I assume you mean for centers. So yes, mitigating taxes and estimating taxes is definitely applicable to childcare centers as well as homes. Things are a little different when you have a business tax return that does not mingle a family's return with a business return. So this profit-driven approach that we're talking about is absolutely applicable to centers as well. We're going to now switch gears and talk about a family income approach. That is not as applicable to centers unless they are filing their tax return on a Schedule C that goes along with their family tax return. Okay. And I'm just going to put a plug into Margaret, my colleague, who is on this call, and see if she, oh, I think that Emily sent me the question. Okay, so I'm going to look at these two questions that are both in the chat and were sent just to me. If I underpay or overpay often, what it looks like for the IRS means they may want to penalize me. If you overpay taxes, the IRS is not going to penalize you ever. They will give you the money back in the form of a refund. If you underpay, yes, they will absolutely penalize you. Seema, let me know if that answers your question, okay? I am a family daycare. How can I reimburse myself? So I think this means, I think this is in relation to the question that I asked earlier, that was asked earlier and answered about reimbursing yourself for the business portion of your tax bill. So if you are a family provider and you file a 1040 that has a Schedule C, that end result, that tax bill that you owe, will very likely be a combination of a personal tax bill and a business tax bill. And what you will need to do is pay that out of your own personal account, because you don't want to pay it with a business account when it's a family expense. So it's better to pay it out of your personal account, which I know is not the greatest, but then you need to calculate the business portion only and reimburse yourself from the business account to your personal account for the specific business portion of the tax bill. Laura had a question or a comment in the chat, which is a note that she wishes she could see the other questions. So I'm going to put another plug in here for the Q&A. If you type your question in the Q&A, and if you look at the bottom, I know it's confusing. The chat icon is right next to the Q&A icon. If we could all put our questions in the Q&A, then everyone will be able to see them, which I do think it'll make it easier for people to understand what I am answering. So thank you. And there is a way to do it anonymously, I believe, if you don't want people to see your name. Okay. All right, just checking to see if we have other questions. These were both answered. Okay. I am going to keep going, and I will pause again for questions. I know that taxes are a dense and difficult subject, and there are a lot of numbers involved in this. So I'm happy to pause, slow down, answer questions as needed. So feel free to keep the questions coming. I really do appreciate them. Okay. So now we are going to talk about the family income driven approach. And as I mentioned, this is really for any provider who is filing a tax return that goes on a Schedule C, which can be included in their 1040. So back to our example provider. Let's say that she wanted a more accurate number for her estimated tax bill. One way to do that would be to use this family income driven approach. It requires more data to use this method, but it also results in a more precise number for your taxes because it is based on your overall household income and deductions. So the first step for this is to gather additional data. In addition to the information that you have already collected, the income and expenses and estimated tax payments, to use this approach, you will also want to have any W-2 income information for both you and or your spouse. Specifically, what you will need is your total annual pay and how much withholding has been deducted so far. One easy way to do this is to look at your latest paycheck and check out the year-to-date amounts. You can divide them by the number of months to date, which gives you an average monthly amount, both for income and withholding, and then multiply that amount by 12 months in order to get an annual amount. So back to our example provider. Let's say her spouse's paycheck showed through the end of June that he had earned $54,000 and had $12,000 withheld in taxes. In this case, we would divide both numbers by 6, because in this example, it's the end of June, to get a monthly average of $9,000 for wages and $2,000 for withholding. We can then multiply the monthly averages by 12 to get an annual average, which gives us monthly wages, just to see the calculation there. The monthly wages are $54,000 divided by 6 months equals the $9,000 of wages per month, which I mentioned. Monthly withheld taxes, $12,000 divided by 6 is that $2,000. So then the annual wages, 9,000 times 12 equals $108,000. And the annual withheld taxes, $2,000 times 12 equals $24,000. The other information you'll want to gather, anything about your children's ages and educational status, your mortgage interest for the year or rent if you have it, and your property taxes. So like I mentioned, it does require gathering more information. And the next step is to calculate your estimated taxes. And I'm going to be totally honest that calculating your estimated taxes for using the family income and characteristics can be super time consuming if you try to do it by hand. It's a complicated formula that I wouldn't advise trying to do on your own unless you are really very good with math and very good with taxes. Instead, what I would recommend are using one of the free online calculators that are out there. We have tested several of these, and the ones we like are called Get It Back, H&R Block, and then there's one from TurboTax. And I am going to share links to all of these in the chat right now, and I will make sure you can all see them. And that skipped the slide on me, but here's the chat. I'm going to send this to everyone. I'm going to do this one at a time because it's grouping them all together. Okay, so there is the link to Get It Back. Next, I'm going to share the link to the H&R Block tool. And the third one will be the link to TurboTax. Unfortunately, these are not available in Spanish, but you can use your browser translator to translate the information on the screen. So to go back to our example provider, let's say she entered all of her information. We're going to just assume that everything she gathered, she put in there. And what she found out was that when her deductions were included for her whole family, she didn't need to make any other tax payments because it reduced the total taxes due for her family. And she found out that it was less than what had already been withheld from her spouse's paycheck. So because they file a joint tax return and that withholding is on there, they've already paid that. So withholding from a W-2 paycheck is basically the same as paying estimated taxes because the IRS has that money. Okay, so someone had a question. How do you copy the chat again? You should be able to click those links and open them right in your browser. When I am done with the presentation, I will definitely stick around and make sure they are working for everyone. So we can talk about the links if they're not working, but I don't want to get bogged down in those now, but I will certainly take a look at them at the end and make sure that they are working for you. Okay, so now we're going to discuss step 3, which is the good one, mitigating taxes. So I mentioned in the previous example in step 2, our provider didn't need to pay additional taxes. But if she did, or even if she just wanted to save even more money, she still has time to mitigate her tax bill. The key here is that knowing how much you owe is only part of this exercise. You also want to identify how you can reduce your tax bill while you still have time. And that's why we do this before the end of the year. You know, it's mid-October, like I mentioned. So we have time now until the end of December, until, 11:59 p.m. on December 31st. You have time to mitigate your tax bill. So now we're going to go over some common strategies for doing that. So here are the most common tax mitigation strategies that are used by childcare providers. And I just want to be fully upfront about this, that these strategies are for providers who have money available. You don't want to be spending money you don't have. And so this is for the providers we mentioned who are showing a profit. And we are going to talk in a little bit about what happens if you've done all this work and realized you're not making a profit. But say you have a profit and you think, that profit is leading to a heftier tax bill than you would like. Here are some things you can do before the end of the year in order to owe less money at tax time. And the first one is to contribute to a retirement plan. If you don't already have a retirement plan for your business, setting one up is a great idea. This is just money that you or your employees will get back later, and it comes with tax advantages now. Contributions made to a retirement plan on behalf of the business owner and employees are typically tax deductible. And there are retirement planning guides that will be going up on the Thriving Childcare Business Academy very soon, so I would suggest looking for those. They should be up around the end of the month. Another thing you can do is maximize your home business deduction if you are a family care provider. If you are a family care business, one of the greatest deductions you can get is for the business use of your home. You will want to make sure that you are recording your time accurately and capturing expenses by exclusive or regular use. And this is something I see a lot when I talk to providers and look over tax returns, that they are not calculating their time space percentage correctly and leaving money on the table for the IRS. And again, we will have a self-study guide on the Academy that talks a lot about that. And we will have a webinar on that topic soon, but definitely maximizing your home business deduction. And that was for family care providers, but it also goes for center businesses as well. If you are a center business owner and it is appropriate, you may be able to deduct home office costs. That's something that is certainly worth looking into. And now the next one is look for other deductions. So it can be worth the effort to think about the things that you need for this year and next year. Are there items that you can stock up on now? Is there anything that you're renting or leasing that you may want to just buy instead? Is there an investment in your playground or your business, the inside, your furniture, your equipment, your supplies that you could purchase now? And again, to be clear on this, you want to make sure that you're not spending money frivolously. If you can make a purchase this year that will save you money, that's great, but buying something you don't need is not a good use of your money. If you think about it, people often say this around sales and things like Amazon Prime Day. And if you don't need it when it's on full price, when it's at full price, you still don't need it when it's on sale. So you're not saving that money if you're purchasing something you don't need. Another way to mitigate your tax bill is to pay down your debt. And it's not necessarily a one-for-one deduction, but if your business has any debts and you have extra profits, pay them down. Getting rid of debt saves you and your business money in the long run by reducing those interest payments. And we all know that interest rates are going up, and it can be really taxing to have business debt. Another thing you can do is to create a reserve fund. Creating a financial cushion for your business can be super beneficial. If you have higher profits and steady expenses, it's really worth the time to think about setting aside some of those profits in a reserve fund to cover future expenses or unexpected costs. We've all been through COVID, and we know that really unexpected things can come up, and let's hope we don't have to do that again. But just know that having a reserve fund and investing in that when you can helps you weather events like that in the future. Another thing you could do is invest in business expansion. If you have higher profits, you might consider investing in the growth of your business. So this could mean something like hiring more staff, expanding your physical premises, launching a new service, or investing in marketing and advertising for your business. Marketing and advertising is a really good one because that is the type of investment that could potentially lead to higher revenue in the future. Another way to mitigate your tax bill is to defer income. So if at all possible, you could consider deferring some income to the next tax year. So say someone owes you money and is going to pay you in December, you could ask them to pay you in January. This can work out in some ways, but keep in mind that it can increase your tax liability for the following year. You're still getting that money, you're just getting it later. So that's something to keep in mind when you think about deferring income. But getting that money in January also gives you more time to think about, investing in some of these items and mitigating your expenses for the next year. And then the last thing I'll mention is charitable contributions. Consider making a contribution to a charitable organization near you. Not only does this support your community and it acts as advertising often for your business, but it also can provide you with a tax deduction. Okay. And now we're going to talk about what I mentioned earlier. What if my revenue is low or negative? So it can happen, as we all know, when you review your numbers, that taxes in your tax bill are not your issue, but instead you are on track to make less money than last year, or perhaps even lose money. So if this is the case for you, these are some things that you should think about. First, review and reduce expenses. The first step should absolutely be to review all of your business expenses in detail and to identify any areas where costs can be reduced without having an impact on the quality of your service. This could include things like switching to more cost-effective goods or services, reducing unnecessary overhead costs, or identifying ways to use your resources more effectively and efficiently. Something we always point out about reducing expenses is to look at things like subscriptions that you may have. Are you using them? Do you use BJ's and Costco? Do you need both of them? If you're paying for duplicate subscriptions like Netflix and Amazon Prime Video, are you really using both of them? So things like that. Another way to improve revenue is to improve your billing and collection processes. So if slow paying families, for example, are a problem, consider thinking about how you're billing and collecting money. This could help increase cash flow and reduce the need for borrowing money to cover expenses. Something we also like to point out about billing and collection, if you bill monthly as opposed to weekly, you could be leaving money on the table, because often people think that, there's 4 weeks in a month, I'll just charge the 4-week rate for a month. But there's actually a lot of months where there are 5 weeks. So in all of those months, you could get that additional week of revenue. So if you think that is something that would work for you, that is a great way to increase your revenue. Something else you could do is explore financing options. And this is really advisable for businesses who are facing a temporary cash flow problem. You could consider a short-term business loan or a line of credit to help you cover your expenses, but keep in mind that this should really be approached with caution, as it leads to additional financial obligations. And that just means, more bills you have to pay. And then evaluate your pricing strategy. I already talked about billing weekly instead of monthly, but think about whether or not it's time to raise your prices. Costs have risen. We all know that. We're all familiar with how much more expensive things are right now. So think about that. Do you need to raise your prices? And if you do, make sure you're thinking about it carefully, as it could impact, retention of your families and attracting new families. And then the last step I would recommend is seek professional guidance. If you're really struggling with lower revenue and higher expenses, seek the help of a financial advisor or a business consultant for support. They can provide a fresh perspective and suggest strategies for improving financial stability. And I'll put another plug in here for some of the programs we're offering through the Thriving Childcare Business Academy. We are offering small study groups. You can sign up for those on the website. And I'll make sure the website link is shared with all of you as well. Those small study groups have a lot of valuable information and talk a lot about revenue, which is great whether or not you're making enough money now or not. You can, if you're losing money now, it's great, but also if you have a profit, there are strategies for increasing that. Okay, so we've talked a lot about proactive planning for year-end tax savings, and it really is a crucial process for business owners. So analyzing your revenue, your expenses, looking at your estimated tax payments, It helps you estimate your profit and your tax obligations, and it gives you a really good picture of where your business is. It can give you a chance to change the direction of your business if you're finding that revenue, not taxes, are your biggest issue. And just remember that the things we've talked about are broad strategies, and the best approach will always depend on the specifics of your business. It's always a good idea to consult with a tax professional or a financial professional if you have questions about your business, your unique situation, and are looking for help making decisions about that. And now I'm going to open it up to questions. Okay. So a couple people asked about offering a health plan. Yes, benefits that you offer to your employees can be tax deductible. It's not always the case, and I am going to find a link for you that you can that I can put in the chat about offering benefits. And it's going to do two things. I'm going to give you a link to one of the study guides that is posted on the Thriving Childcare Business Academy website. So it'll give you some specific questions, but it will also show you where you can access these. So I put a link in the chat that everyone should be able to see, which talks about benefits for employees. And if you scroll down through there, it talks about the IRA that I mentioned, as well as insurance and some of the tax benefits. The self-study guide that I linked to is not specific to tax burden, but it does provide some information about health insurance and how that can help you with your taxes. So I would advise reading that self-study guide. And I am also going to put a link to the Thriving Childcare Business Academy website, which you may have seen already, but lots of good resources there for childcare businesses of all sizes. Okay. Any other questions that anyone wants to ask? And I think did I owe someone another link, or was it just the Childcare Business Academy? If you're waiting for a link, feel free to type it in there. Or if you have another question, anything at all, feel free to type it in there. Seema typed a question into the chat that I just wanted to read. How does a reserve fund help reduce tax payment? So Seema, that's an excellent question, because really it's not going to reduce your tax payment. It's just a really good way to use excess profits if you do have those. If you have looked at all of the other options that could reduce your tax burden, things like making a charitable contribution or opening an IRA for your employees, those have a stronger link to reducing your overall tax burden. But having a reserve fund is just a really good way to make sure your business is strong and ready for the future. Does anyone have any other questions that I can answer? I'm happy to answer questions about this topic or about the Thriving Childcare Business Academy in general. Okay, a question in here. It's not clear to me if I have a family childcare, I must pay my tax services from my personal account or my business account. If you have, if you are a family childcare, if you are filing taxes on a 1040 with a Schedule C and you owe money at the end of the year, then you would want to pay that tax bill using your personal account. If you are making estimated payments throughout the year based on your business, those quarterly estimated tax payments can be made from your business account. That is a business expense. That is a fair use of your business money. You are mitigating your business tax bill. Please let me know if that answers your question. And then there was a question in the chat, how many years can a reserve stay in the books? That is a question, Vic, that I don't know the exact answer to, and I do not want to give you the wrong amount. It would really depend on the specifics of your business and would be a question for your financial advisor or your tax preparer. I will say that showing a profit on your taxes, that's okay. That's, showing a loss, a repeated loss on your taxes can be a red flag to the IRS. But if you have a reserve that in terms of showing a profit year after year, that is totally fine. Any other questions? I will stick around for a few minutes and just see if anyone has any other questions. But if you don't, you are free to leave, and thank you so much for attending. We appreciate your time. Thank you. There was a question about, do we need to give you our information to receive credit for this on our Georgia PDS account? That's a good question. Thank you for asking. If you signed in with your the name and email address that is used in the Georgia PDS system, you will be able to receive that automatically. We can issue that. We can issue that to you. If by chance you are still here and you signed into the Zoom with a different name, if you signed into the Zoom with a different name than you have on your Georgia PDS account, you should let us know, and you can put that in the chat for us. Thank you. Laura, I'm sorry that you weren't able to see questions. It looks like a lot of people put them in the chat directly to the hosts and panelists. So my apologies. I did try to read them, so I hope you were able to get that information anyway. Thank you to everyone who attended. Seems like there's no other questions, so I'm going to go ahead and end this session, and you should all receive that Georgia PDS certificate soon. So thank you so much. Thank you, Emily.